Hello everyone, so a month out from the highly anticipated first budget by the new Labour government from Rachel Reeves. About a month away, what do I think is going to be in that budget? All sorts of speculation. A lot of this stuff is out there in the press. Commentators left, right and centre are giving their two penneth words as to what may happen. The only things that have definitely been confirmed, we know about, is, it's already been announced. It's not going to be in the budget, but it's the VAT on the school fees, changing of the non-dom status. So what else has she already said? Well, she's already said no change to income tax, VAT, corporation tax and national insurance. So what is there left to play with? Well, let's have a little look. So, first thing, income tax. Hang on, you just said there's no change in income tax. I don't think they're going to change the headline rates of income tax or the point at which you pay, higher rate, for example. So the thresholds will stay the same. The rates of income tax will stay the same. But here's the biggie. Curtailing income tax relief on personal pension contributions. They reckon, they've costed it out, the maths bods at HMRC and the OBR, that it costs UK PLC around about £50 billion a year for giving tax relief, income tax relief on personal pension contributions. And mostly it's higher rate taxpayers who benefit, who are saving tax at 40%, 45%. So they reckon that is definitely going to get curtailed. What's it going to get curtailed to? Well, it could be that it's a flat rate. So everyone who's currently a high rate taxpayer, additional rate taxpayer, they would get their relief restricted to 30%, for example. Or it could come down to 20%. Or indeed, if it is a truly flat rate, what's going to happen to the people saving at 20%? Will they be bumped up to 30%? Yes, that'll cost money to the Treasury, but it'll be dwarfed by the savings of all those people who've gone from 40, 45 down to 30. So who knows exactly how they're going to play it. But my money is on that they will seriously curtail tax relief on personal pension contributions. So that's income tax relief we're talking about, without changing the headline rates of income tax itself. Next one, capital gains tax, CGT. So, alignment of the rates. That's got to be on the cards. Right now, the maximum rate of capital gains tax on anything is 24%. On residential property, if you're a higher rate taxpayer, you pay 24% capital gains tax. We've already talked about income tax. Some people are 45% taxpayers. So there's a big disparity between the maximum rate of CGT and income tax. And I think they will up the rates of capital gains tax. Will they align it to income tax? Possibly. 40%, 45%, who knows? Or again, just a target rate of 30% maybe. But right now, I think that the government thinks that capital gains tax, the rates are too low. Also, what about reliefs? We talked about income tax relief on pension. What about capital gains tax reliefs? Well, one of the big ones is what we call business asset disposal relief. Used to be known as entrepreneurs relief for many years. Basically, it's a tax break that says if you sell your business or certain other types of assets, but broadly speaking, you sell your business, you're an entrepreneur, you built up your business, you flog it for a few quid. The deal is that you pay 10% capital gains tax on the first million and then 20% thereafter. Now that £1 million arbitrary figure used to be 10 million. Sunak brought that down when he was Chancellor. He said, listen, we're going to bring that right down to 1 million. So right now, if you were selling a business today and you've never sold a business before and you sold it for, £2 million, you'd pay £1 million at 10% and £1 million at 20%. That's your CGT bill for selling your business. Now that, several commentators are saying that could go altogether entrepreneurs relief because it costs the country a couple of £1 billion a year to give that relief to entrepreneurs. So I think the current government thinks, well, they're getting enough anyway for the fact they're selling their business. They should pay more tax, not just some of it, a big chunk of it at 10%. So predictions, business asset disposal relief could go completely. And the default main rate of capital gains tax applies when you sell your business, which is currently 20%. But like I said, if they're going to increase their headline rates anyway, goodness knows what that could be. So are they going to say increase the headline rates of CGT and then put a separate cap for entrepreneurs relief, say that it's going to be 20% minimum? I don't know. It's all up in the air. Who knows? But my predictions are restrictions, curtailment of existing relief for business asset disposal relief, otherwise known as entrepreneurs relief. Next one, tax-free uplift on death. One of the best ways to avoid capital gains tax is to die. In fact, it's the best thing you can do to save capital gains tax. Seriously, because when you die, your assets that are passed on to whoever you've left them to, they essentially acquire them at the probate value, or the value that they were when you died, and they get them at that starting point. So there's no capital gains tax. So when you die and pass on assets, there is no CGT. Yes, there's inheritance tax. So you might say, well, that's fair enough, because if you had both inheritance tax and capital gains tax, surely that's double taxation. Yeah. Well, you could even argue that double taxation is in place to begin with anyway, because your wealth that you are creating is from your after-tax income. You pay tax on wages, salaries, whatever, and then you're building stuff up to invest, and then you're getting hit for IHT at the back end when you die. So that is double tax to begin with. This is almost like triple tax, adding capital gains tax into the mix. But they reckon that could seriously be on the cards. From what I'm hearing in the ether, that the government are looking at getting rid of the tax-free uplift on death for capital gains tax. So let's take an example. Let's take £1 million as a good example. You're paying IHT anyway because you've got your personal residence and everything else is exceeding the threshold. So inheritance tax is on the cards when you die, and you've got a particular asset worth £1 million, a property that is going to be gifted to one of the kids. Okay. So inheritance tax is payable at 40% currently on that property. So that's 400 grand on that. But then as it stands now, that £1 million property goes to the kid, basically the child that would acquire it at that value, so that if they sold it in 10 years, say it was gone from £1 million to £2 million, they'd only pay capital gains tax on the uplift from the point at which they acquired it. So it was worth £1 million, double the money in 10 years, pay capital gains tax on £1 million. What they're looking at doing, I'm hearing, is saying, well, hang on a minute, that property was originally acquired from the deceased bought it for, I don't know, 100,000, and then you give it to pass it on death to the kid then sells it, so that capital gain should be on the full amount from the difference between 100 grand when the deceased bought it way back when, and when the beneficiary sells it for 2 million, rather than the million. So in that instance, in that example, it would be capital gains tax on 1.9 million instead of 1 million. That would bring in a huge amount of cash to the exchequer. That is rumoured to be on the cards. Abolition of the tax-free uplift on death for capital gains tax. Alrighty, what else? IHT. So, pensions. At the moment, pensions do not form part of your estate for inheritance tax planning. They haven't done since about 2015, when the so-called pensions freedom rules came in. George Osborne brought in when he was Chancellor, made it a lot more attractive to save into pensions, more of an incentive to do things with pensions, one of them being that you could leave it to the next generation tax-free of inheritance tax. But will Labour bring some sort of linkage back to pensions and IHT, basically saying that pensions will fall in your estate? There's rumours that could apply. What's this? BPR, Business Property Relief. All right, so let's come back to the example of the guy who sold his business for a few million and he had his entrepreneur's relief, but was saying that could go. Assuming, though, the guy didn't sell his business and he just dies owning his business. So he's got a business worth a couple of million and he's making his widgets and he drops down dead. Now that value of his shares in that company, which is in his estate because he owns it, would nevertheless not form part of his taxable estate for inheritance tax, because it qualifies for what's known as BPR, Business Property Relief. It's a bit of a misnomer because it's nothing to do with property, but it's in the sense of bricks and mortar. But it's basically it's an exemption. Now, what other things qualify for this BPR? Well, one of them is actually investing on the junior stock market, the AIM. So let's say you had a load of cash, and that cash potentially is in your estate for inheritance tax. One of the legit ways to get it out of your estate to mitigate any future inheritance tax is to invest it on BPR qualifying AIM shares. So you put all this money on the junior stock market. Now, the reason the government have done this is because it's a risk thing. They say, look, it's riskier when you invest on these small startup listed companies, but they're still risky even though they're listed because they're not FTSE 100. A lot of them do go south and tank. So they've brought the rule in to say to encourage people to inflow capital into this junior market, this stock market, the AIM shares, will bring in this inheritance tax break, which basically says if you own these shares for 2 years, they fall outside of your estate for inheritance tax. So actually it's quite common in the financial advice world for what we call deathbed planning, where we've got someone who's about, for want of a better phrase, shuffle off this mortal coil, and we know that they're getting advanced in years, but they've maybe got a couple of years left. All of a sudden, get them invested on the AIM, on these shares, because within 2 years that falls out of their estate. Unlike, for example, say just gifting cash, where you've got to survive 7 years, the old 7-year clock to escape IHT, get invested in the AIM, you only have to wait 2 years for it to be out of your estate. Now, that investment qualifies for BPR. It's like having your own business. No IHT. That could go. There is rumours that could go. The idea of investing in those. Now, there's quite a big percentage of capital in that market which is in there just because of this reason, to escape IHT. You all of a sudden put the brakes on that if you're the Chancellor. What's going to happen to all the capital? Is going to be capital outflows. It could really decimate that market. So, who knows? Who knows? But anyway, that's on the cards. That's what we're hearing. Let's see. Next, APR, agricultural property relief. This is basically land, farming land, agricultural land, which can be passed to generation because there's no death duties, no inheritance tax, because it qualifies for this thing called agricultural property relief. And it farms and various things. And I think the government, from what I'm hearing, don't like the fact that this is in place because it costs so much money in terms of tax relief, and they could get a nice chunk of change off people if they abolished that particular inheritance tax break. So landowners, and of course it's people who have tenanted land, not just farmers, but people who own the land. There's people in there working it. So there's all sorts of ways you can avoid inheritance tax using land and doing clever things with the land. I don't think the government are big fans of that. That is on the cards to be abolished. Watch this space. Right, what else have we got? All right, so pensions in general. We talked about one or two things on pension relief being curtailed, we expect, for income tax. What about the actual lifetime allowance? So you remember there used to be this arbitrary cap where the government said, if you have so much money in your pension, once you go beyond that level, we're going to hit you for some tax. So you get tax relief on the way in, tax-free growth, but if you have too much growth, we're going to clobber you for tax. It's just like tax coming out the bloody woodwork every which way you can. But the point is, that was grossly unfair, because if you've got a decent investment brain or financial advisor, through no fault of your own, you're paying in the amounts and you're having really good investment returns that just can go up and up and up. You can't, there's no ceiling on the potential upside and how you can make money on the stock market, right? But if you bust this amount through no fault of your own, because it's not capped to the total that you put in, it's the value it's grown to, but that could grow to some big amounts. So it was quite unfair. But anyway, the government said they don't care about that. And we're talking about successive governments, not just the current lot. They said, right, well, you can do 2 million in your pension. No, we'll change that. We'll make it 1.8. We'll make it 1.5. And then they just played around with it and got it down to 1 million. A lot of people, particularly in the health sector, a lot of GPs and doctors were busting that £1 million cap. They were just retiring left, right and centre. early, all this brain drain of all these key workers, the medics. The government said, we don't like that, that's not what we want. To encourage them to get back into work, they said, we'll abolish this lifetime allowance, this arbitrary number that we just plucked out of thin air. You can save whatever you want in your pension. Save as much as you want, no restrictions. Happy days. Now, again, is this rife for the new government to say they're going to bring it back in? Interestingly, when the last government abolished it, the Tories, straight away Labour said, oh, we're just going to reverse it if we get back in. What was that, a couple of years ago? Since, there has been noises that they said they're not going to reverse it. But now they've got this 22 billion black hole to plug. Will they now start to think, actually, you know what, we'll save a few quid by bringing back, reinstating the LTA, the lifetime allowance? So who knows? Watch this space. I think that would be a disaster if they did, but there you go. What else? Oh yeah, fundamentally change how pensions operate. This is an interesting one. It's been on the cards for a while. Pensions model, tax relief in, tax-free growth, tax at the back end, other than the lump sum, which is another thing, that tax-free lump sum, which is another thing they may look to curtail. But basically that's the model. Tax relief now, pay tax later. ISAs, it's kind of the opposite. ISAs, there's no tax relief on the way in, but you get tax-free growth and you pull it out the back end tax-free. So, but you're losing out, the government's losing out on the fact you can pull money out of the back end tax-free compared to pensions where you pull it out and it's taxable. But you think about it, you'd rather have the tax money now than later. So in other words, what they were thinking is to make pensions fundamentally like ISAs. So no more tax relief on the way in, and notwithstanding the fact I said they could seriously curtail it, what if they actually fundamentally changed it, abolished it completely, tax relief into pensions, said, look, but you can save whatever you can save in there, and then at the back end you get your hands entirely tax-free on the money. Now that basically shifts, like I said, the expense from now to decades potentially down the line, which is a lot more palatable to any government wanting to raise money. So a fundamental overhaul of pensions to make them more like ISAs, potentially. Speaking of ISAs, last point, rumours are afoot that they don't like the fact that there is so much tax-free stuff swirling around in ISAs. There's talk of ISA millionaires since these things were brought in, and their predecessors, the PEPs, the TESAs. Yes, there's a finite amount you can save every year, but over the last 20 odd years, with a fair, like I said, through good investment advice, there are people now with £1 million plus pots in their ISA. And all of that capital growth, completely tax-free. There is rumours they are going to introduce some sort of capital gain. So any gains that you make in your ISA over a certain threshold will be subject to capital gains tax. The tax-free growth, no capital gains tax, as it stands now, could go for gains over a certain amount. What will that amount be? We don't know. So that's another prediction there, changing the ISA rules because they are far too generous, so they cost the country far too much lost tax revenue. That's another prediction. So there you go. So there's what I'm hearing out there as a tax advisor, reading the press, hearing things in the news, where I think, because I've seen it all before in terms of what people have suggested, what comes in and out of fashion, everything else. So these are predictions, and I hope that many of these don't come in, but I'm certain some of them absolutely will come in. I think the ones that will absolutely come in is income tax relief, restrictions on personal pension contributions, and increasing the rates of capital gains tax. That will absolutely come in. All the rest, who knows? Let's wait and see for the 30th of October. So if you like this video, please do subscribe, and as always, I'll see you soon.